Hello, this is Josh Belk with the Belk on Business podcast. Hope you are having a wonderful day. On today's podcast, we're going to talk a little bit about civil fraud as it relates to tax fraud. And I know it's a topic that isn't probably all that popular, one that we really care to think much about. But I think it's a really good foundation that can provide us as business owners a little bit of an understanding of some areas we need to make sure that we're focusing on as it relates to really, especially our manner of activity and our record keeping. So I'm going to kind of use this topic a little bit to try to educate, maybe more remind the listener as to some of the expectations the IRS has as it relates to us as business owners, as it relates to our way that we operate in our business, the way that we keep our records especially, and hopefully this will provide a little bit more of an understanding, a little bit of a broader understanding as to those expectations. Of course, we just had yesterday, as I recorded this, a law passed, and it's providing some funding for the IRS to hire in excess of 80,000 employees over the next number of years. And of course, it's there are some tax increases that are going into place that's going to affect most Americans. And so I'm not really perceiving there's really a whole lot of kind of great things in this. And we'll talk about the tax side of it in another podcast. But for today, really kind of understanding that one of the goals of this particular piece of legislation was to try to get the IRS more help. Now, as a tax professional, as someone who has to deal with the IRS, it would be kind of nice if there was some support there. But I think, unfortunately, a lot of the emphasis behind this was more on the enforcement side than on the more of the customer service side, actually getting people to answer phones, et cetera, try to get the help to the taxpayers and to the tax professionals as well. So a lot of what we're seeing is, I think, an emphasis on more on the enforcement side than on the actual kind of customer service side of the IRS. Now, as a little bit of a background, when we kind of go back and look at 1955, the tax code was about 929 pages. Now the tax code is over 6,600 pages. So it's a rather large document, and one that, to be honest with you, even as someone who's been in the field of taxes for decades, still really only really truly understand kind of a great working knowledge of a portion of it. There's vast parts of the tax code I don't work in a whole lot, and of course we would refer a lot of that if we run into a situation. We refer that particular help off to another accountant that might have more experience in that area. So there's no way in the world, I think, that for most, if not all, business owners that aren't in this day in and day out really aren't going to have the level of working knowledge to where they're going to get everything right. But I think there are, as we look at these kind of 11 kind of rather common areas that the IRS will look into as it relates to tax fraud. And if we're running into a situation to where a taxpayer is operating in a way that could be considered fraudulent, or there may be fraudulent intent, then, of course, that particular taxpayer is, and those penalties can be quite severe, and hopefully it's never a situation you have to deal with. However, as we kind of walk through this, I'm going to try to give you some helps as it relates to making sure you have a good understanding of some of the record-keeping requirements or the manner of activity requirement that the IRS generally looks at. First of all, dealing in cash. So, of course, nowadays, my business, I have an accounting firm, one of a few businesses that I have, but I have an accounting firm, my primary business. And in our firm, back when I first started, I used to do a lot of individual returns, and I have clients come in and they would pay me cash. Nowadays, I can probably count on one hand, since we deal primarily with businesses, I can pretty much count on one hand the number of times that a client may give us cash during the course of the year. But there are businesses that they still operate very heavily in cash. And but it's just not just kind of the cash side as far as receiving cash, but also the way that we deploy the cash. So if you are a cash-based business, you want to make sure, and I think this is true for all businesses, regardless if you're cash or not, but making sure that you have a good point of sale system in place if you're dealing with customers coming in, buying products off the shelf, for example, and to go up to a cash register and walk out. Make sure you have a really good point of sale system in place. That you invoice your clients. So I know here at the accounting firm, I know with most service businesses, we are going to remit invoices to our clients. So it's just not the invoices, but to make sure that those invoices are sequential as well. So have a good invoicing system in place. You are billing your customers. that if you have sequential receipts, so if you have the type of business to where people come in and they pay you and you use kind of those old handwritten receipts, I think it's really good to use those carbon copy books. So the receipts are sequential. If one of the receipts gets messed up, you're writing void on it. And so there is a manner of activity. There is a flow, a process as to the way that you receive cash from your customers and the way you receive payments from your customers. So in an audit scenario, if they're taking a look at that, they can actually go through, look at those receipts, see that they're sequential, see that you are providing customers receipts, and you're not just going through and people are just coming in buying things, and there's a possibility of you sticking the cash in your pocket. So use sequential receipts and always reconcile your cash to your receipts. I think this should be done probably on a daily basis to where at the end of the day, you take all of those receipts, you add them up, and you reconcile that out to your payment that you've received, both from your merchant if you're using debit and credit cards, and also to your cash. So if you're dealing in cash, make sure that you're handling it in a way that is prudent. The next part of this is to make sure that you never pay employees, contractors, or vendors in cash. And so you're not running into a situation to where you're out and if you have a construction company, you're paying people in cash and then trying to write it off later on. Okay, to make sure that you're receiving invoices from your contractors, you're paying off of those invoices. If it's your employees, you're not paying them in cash. Any sort of money that they receive, it is reported and it is recorded on their tax returns, or I'm sorry, on their W-2s and on their pay stubs. Okay. Number two, just simply failing to file a tax return at all. So first of all, the first one common area the IRS may look at, will look at if you're in an audit scenario as far as dealing in cash. Secondly, just a failure to file tax returns at all. So this is just simply trying to avoid the system, not filing returns at all. But eventually it probably will catch up to you, especially if there's some reporting of your income to the IRS. And if you go years without filing, the IRS can come to you and say, you know what, you are just simply just acting in a fraudulent way. And so not only will they it's not a situation where you're going to jail necessarily, okay, but it is a situation to where you will face additional fines and penalties. You can lose your opportunity to be able to itemize deductions, for example. So if you decide you want to go back and try to prepare returns, when the IRS steps in and says, okay, we're going to prepare a return for you, it's going to limit what you are able to do on that particular return. So I think it's extremely important that you file your returns, try to file them timely and accurately, and do it consistently. Number three, filing false documents, including false tax returns. So just simply filing a fraudulent tax return, okay, a tax return that you know very well is not true. Okay, or filing other types of false documents. So sending 1099s out to try to overstate your contracted labor, for example. Okay, so just simply using other tax documents to try to overstate expenses, for example. And just trying to use other ways, just simply filing false tax documents, including false tax returns. Number four, understating income. And this is probably one area. So generally when you're running into a situation where there's an issue with the tax return, usually it's understatement of income or overstatement of expenses. Okay, but understating income. Make sure that you're keeping your books. I mentioned this earlier in the cash section here, but make sure that you are keeping good books. In this day and age, we have the technology, and there's plenty of service providers out there that can help you with this. Okay, to make sure you have good, clean books. That everything is flowing through the bank account. That those bank account transactions are coming into some sort of a platform. That you're pulling those in. You're doing your bank reconciliations. You're doing all these things that should be done on a daily, weekly, and monthly basis. And so that way you have a good, clean set of books. It will make things much, much easier if you get into a situation where you're dealing with an audit. So make sure you're keeping a good, clean set of books. That you are indeed invoicing your customers. We talked about sequentiality of receipts. You're doing these types of things. Making sure that you're documenting intercompany transactions. So if you're in a situation to where you own a few different companies, those companies are providing services back and forth to each other. So if you are going through and you have another similar type of company and one company is providing a service to the other company, maybe you have a marketing agency, a marketing company, and it is providing services to one of your other companies. Make sure that there's an invoice there, and that invoice gets paid. If you do need to transfer money from one entity to the other, make sure that it's documented correctly. Okay, so making sure that you that you're not understating income, that all of those money transfers back and forth are handled correctly. Next, keeping inadequate records. Understand what the IRS requires as far as record keeping. Make sure you're keeping all of your receipts. Keep your bank statements, keep your credit card statements for timelines. We've talked about those timelines in a previous podcast, but make sure that you're keeping those records. And generally, it's for 3 years after the filing of the tax return, unless you indeed are committing some sort of fraud. Then in that case, there is no kind of expiration time. But make sure you're keeping all of your receipts. You keep your bank statements, your credit card statements, and make sure your receipts are documented correctly. This is one area where we see individuals, business owners get themselves into, I want to say trouble, but they end up having to pay more in taxes because they have not documented the records correctly. So it may be a situation to where they have the receipts, but they didn't document the receipts correctly. So if we're talking about meals, for example, okay, so if you're going through and it's good, you have a receipt that you went out to dinner, okay, and it has on there, it has the food that you bought, okay, but you need to make sure on that receipt, you need to document who you were with and the purpose of that meeting. So generally, it's pretty good to whatever was talked about or documented in that meeting that you had with a client or with a team member, with a vendor, whatever the case may be, that you document on there some of the things that were talked about. What was the purpose of that meeting? So make sure that it is documented. Your travel, make sure that your travel is documented. So you went someplace. You went to a resort and you indeed went there for maybe it was for a mastermind, for an education a seminar, something to that effect. So you went there. There was a business purpose to it. Okay. And you were there for 7 days. Okay. And you want to try to write off that entire trip. Make sure there's adequate documentation there. You go down there and the seminar is 1 day and you spent 6 days on the beach and you say, well, I went down there for a seminar. Okay. You did not keep adequate records. Okay. And so simply you're going to run into a situation to where you're going to end up having to pay more in tax. So make sure that you're documenting your receipts correctly, understanding what is required and making sure that it's that those requirements are met. Make sure you're keeping your meeting minutes, that any sort of distributions that you make to yourself as a business owner, make sure that those are documented in meeting minutes. Okay. Otherwise, there can be a reclassification of distributions to payroll, for example. So just make sure you keep your records and you keep your records in an adequate way. Next, number 6, giving implausible or inconsistent explanations of behavior. Know what your business purpose is, why you're in business, and make sure your activities align and they are reasonable to what it is that you're actually supposed to be doing as a business. Okay, so make sure your actions are consistent, that they're reliable, that they're understandable, and they're comprehensive. And so when you're having a conversation with a revenue officer or a tax examiner or whatever it is you're having that conversation with, to make sure that there is a reasonable explanation for why you did what you did. Okay, at the point that it becomes inconsistent, it becomes illogical, that type of thing, it's going to raise the ire of the individual doing the audit, and it really can create some complications for you. Number 7, concealing income or assets. Be really careful using offshore accounts. Okay, definitely don't be trying to move money around. So you're trying to conceal revenue, money coming in, and you're saying, well, it's money I put into the company where it was actually revenue, things of that nature. To make sure both in the business and also personally that you're not doing anything that would appear that you were trying to conceal or hide income or conceal assets. Okay, so getting an asset and putting it into the name of something else, hoping that it doesn't get caught where it indeed really should be under the business and it's a business asset. Okay, and it is functioning. So you're going to try to put the asset somewhere else, generate revenue, not claim it. Those are the types of things that will get you in trouble. Okay, so make sure you're not concealing income or assets. Number 8, engaging in illegal activity. I mean, this one's kind of pretty obvious. Okay, if you're dealing in drugs, that are illegal drugs, probably still good you file a tax return, okay, claiming the income, okay, but obviously if you're engaging in any sort of illegal activity, that's going to be, and we look back kind of in the big cases through the years, and the fun cases to read through the years are always, talking about engaging in illegal, activities. Al Capone, what did they get him on, right? Number 9, supplying incomplete or misleading information to a tax return preparer. So that's somebody in my seat. And sometimes we'll have clients that may get a little bit upset or annoyed because we ask a lot of questions. Okay, and we do that in a way to make sure that we understand what the client is doing and in a way that we can help the client. Okay, but there has been situations. I must say that we prepared a return, and I found out later on that a client was just simply lying to us, okay, or misleading, okay, and it can be things that are maybe innocent enough. I drove 10,000 miles last year. Well, we know you didn't drive exactly 10,000 miles, okay. Did you keep a record log? Okay, did you keep contemporaneous records as it relates to your mileage? Okay, and so sometimes that misleading information can be seemingly, okay, well, this is about what I drove or this is about what I spent, those types of things. It's probably the best idea because that tax return is yours. Okay, it is not, even though you may have hired a preparer, you may have hired someone like myself or my firm to prepare your return. That tax return at the end of the day is yours. You're responsible for it. Now, we have the responsibility of doing the best that we can to put together the best tax return that we can for you, and we'll work with you in strategies and those types of things. Okay, but at the end of the day, that tax return is yours. Make sure you're giving the tax professional, the tax preparer, hopefully you're using a licensed preparer, the information that they need so they can prepare a return that truly does align best with what is going on inside of your business. But indeed, if you are supplying incomplete or misleading information to a tax preparer, the tax preparer goes and prepares the return. The tax preparer is not the one getting in trouble if they relied on the information you provided. Okay, you're the one ultimately that's going to be facing the issues. You can't say, well, somebody else prepared the return. Well, no, you're responsible for it. Okay, we actually had a client that didn't, a potential client, not sign up with us here in recent days because we tried to make that clear in engagement letter and they didn't like it. Okay, so just understand that return is ultimately yours. Number 10, providing testimony that lacks credibility. There may be times to where you may get questioned, and generally, if you're getting audited, if you were a client of ours, generally we would not have you in the meetings with the IRS. But if indeed you ended up in that particular meeting or you're getting questioned in regards to your activities, if you do give testimony that lacks credibility, that can be construed as tax fraud. So it's just best to be, if you made an error, just simply say, you know what, I did this and understand the consequences on this is a lot better than giving misleading information, because guess what, the paper trail is usually pretty easy to follow. If there's a lack of a paper trail, then there's other possibilities as far as a way to approach it. But generally, you're going to find yourself in a situation where you're going to pay more if indeed you go through and you try to just give misleading information or a testimony that lacks credibility. Number 11, failing to cooperate at all with tax authorities. And so that whole argument of, paying taxes is unconstitutional. Okay, that type of thing, that just doesn't fly. Okay, so just make sure. I think maybe the big takeaway: make sure you're filing returns. You're filing return timely. You're keeping your records in a way that aligns with what the IRS really is looking for. You're using a good set of books. You're invoicing properly. You're keeping your receipts. You're documenting your receipts, and your business activities do align with the business, with your business purpose. If you're doing those types of things, if indeed you do end up getting audited, most of the time, business owners at some point, if they end up with a lengthy business cycle, okay, they go through these business cycles a number of times, they're around for a while, they at some point will probably end up facing some sort of an audit. And it's not anything to be scared of necessarily, okay, unless you are indeed committing fraud. But it's one, they are very inconvenient. They are a pain in the backside. But generally, if you have somebody working with you, your tax professional is one that understands how to work with the IRS. Usually the process, even though it is a bit painful, it can be one that can be worked through in a way that that pain can definitely be minimized as much as possible. Once again, this is Josh Belk with Belk on Business Podcast. Hopefully this particular podcast did bring you some value. If it did, if you haven't already, please consider subscribing. Have a wonderful day.